All right, let's talk about something that comes up all the time in estate planning, the QTIP Trust. That's Qualified Terminable Interest Property. It's an incredibly powerful tool for sure, but it also comes with this nagging fear. Are you accidentally setting up your family to get hit with taxes twice? Let's get into it. So here's the core question we hear all the time. You do the smart thing. You set up a QTIP to provide for your surviving spouse. You take the marital deduction. But then, when your spouse passes away, it feels like the IRS gets to come back for a second bite of the apple. Is that what's happening? Is this some kind of double taxation penalty for trying to plan correctly? Okay, so the short answer, right out of the Internal Revenue Code, is yes, the assets are included in the surviving spouse's gross estate. But, and this is the absolute key to this whole explainer, this is not double taxation, it's actually tax deferral. It's all part of a very specific bargain you make with the government. To really get our heads around this, we have to look at how the law is actually built. First, we'll dig into Section 2044, which is the reason the assets are included in the second estate. Then we'll look at the deferral deal you're offered under Section 2056B7. After that, we'll get practical with Section 2207A, which answers the question of who pays the tax. And finally, we'll talk about the real dangers you need to watch out for: the gift tax trap of Section 2519, and the messy world of federal versus state law. You know, you really have to think of the entire QTIP structure as this, well, it's a delicate balancing act that Congress put together. To really get it, you have to understand how these different sections of the tax code all interact with each other. They're like a set of interlocking gears. Each one has a very specific job, and they all have to turn together for the machine to work. So this table right here, this is basically our roadmap. Section 2056B7 is the prize. That's the marital deduction you get up front. Then you've got Section 2044, which is the payback. That's the inclusion in the second estate. Section 2207A solves the messy problem of who actually cuts the check to the IRS. Section 2519, well, that's the big penalty for trying to break the rules. And finally, Section 1014B9. That's the really nice silver lining to this whole setup. So let's back up for a second. What is a QTIP, really? It's an irrevocable trust that's designed to solve a classic problem, especially when you have blended families. It lets you give your surviving spouse all the income from the trust for the rest of their life, which lets you qualify for that marital deduction. But, and this is the game changer, it also lets you control who gets the assets after your spouse is gone. You decide who the ultimate beneficiaries are. All right, let's start with the first piece of the puzzle. Section 2056B7. Think of this as the quid. This is the benefit, the good thing the government is giving to the first spouse's estate. Honestly, this is the engine that makes the entire QTIP strategy go. So normally, the law says you can't get a marital deduction for what's called a terminable interest, basically an interest that ends when someone dies. But Section 2056B7 creates this massive exception. It says the executor can actually elect to treat the trust as qualified. And when they do that on the estate tax return, the entire value of those trust assets gets deducted from the first estate. Just like that, the tax bill gets put on pause. It's deferred. And this slide lays it out perfectly. It is a quid pro quo, plain and simple. The government says, look, go ahead, make the 2056B7 election, take the full marital deduction, and pay zero tax right now. That's the quid. But, they say, in exchange for that, we get the absolute right to tax those exact same assets in the surviving spouse's estate down the road, under Section 2044. And that's the quo. See, it's not two taxes, it's one tax just paid later. So that's the bottom line. Section 2044 isn't a surprise or some kind of penalty, it's just the other side of the deal you accepted when you took that deduction. The law is crystal clear. If you took a 2056B7 deduction on the first estate, the value of that property must be included in the surviving spouse's gross estate, period.
And the law makes it really, really hard to fight this. Section 2044C creates this powerful legal presumption. It basically says, if a marital deduction was taken on that first estate's tax return, we're going to assume the property is includable. And if you want to argue it wasn't, well, the burden of proof is on you, the executor of the second estate, to prove that a deduction wasn't taken. Good luck with that.
Okay, so this brings up a really good and very practical question. If these QTIP assets are now getting lumped into the surviving spouse's taxable estate, who's supposed to actually pay the tax bill? This is where Congress stepped in and gave us Section 2027A.
I mean, think about it. Imagine the surviving spouse has children from a prior marriage, and her assets are supposed to go to them. But the QTIP trust assets, those are going to her late husband's kids. Does it seem fair that her children's inheritance should get eaten up paying taxes on assets that they will never, ever see? Of course not.
So Section 2207A creates what's called a right of recovery. It specifically says that the surviving spouse's estate can go and get the extra tax back from the people who are actually receiving the QTIP property, the remainder beneficiaries. It makes sure that the tax burden lands on the assets that created the tax in the first place.
And the calculation is all about the marginal increase in tax. It's pretty straightforward. First, you figure out the total estate tax with the QTIP assets included. Then you run the numbers again as if the QTIP assets weren't there at all. The difference between those two figures, that's the amount the estate can recover from the trust. It means the QTIP pays tax at the estate's highest marginal rates.
Now, here's a huge trap for practitioners. It's the waiver. The surviving spouse can give up this right of recovery, and the danger is that a standard boilerplate clause in a will, the one that says pay all taxes from my residuary estate, could accidentally trigger this waiver. To stop that from happening, Section 2207AA2 says you need a specific indication of intent to waive. If you don't have that, you could cause a massive headache, a ton of litigation, and maybe even a taxable gift from one set of heirs to another.
Okay, so we've pretty clearly established that the whole double tax thing is a myth. But that does not mean QTIPs are risk-free. Far from it. So now we're going to pivot away from the basic architecture and into the real-world traps that can trip up even the most careful planners.
And this first one, it's a doozy. It's an Internal Revenue Code Section 2519. I like to call it the nuclear option because really, it's the ultimate enforcement mechanism for the entire QTIP system, and its consequences are, well, they're severe. The rule is designed to be punitive. It says that if the surviving spouse gets rid of any part of their income interest during their lifetime, let's say they sell it or give a tiny piece of it away, the law treats them as if they made a gift of the entire remainder of the trust, not just the income stream, the whole thing. And that triggers an immediate and usually enormous gift tax bill.
All right, the next real trap isn't something you'll find in just one section of the tax code. This one pops up because of the messy way federal law interacts with all the different state laws. And this is where planning can get really, really tricky.
So a whole bunch of states, think New York, Massachusetts, Washington, have their own separate estate tax systems, and they're decoupled from the federal system, which means they often have much, much lower exemption amounts. So a decision you make purely for federal tax reasons, like making a full QTIP election to avoid federal tax, that might be binding for state purposes and accidentally trigger a big state tax bill on the first death. Or it could trap the surviving spouse in that state's tax system even if they move away later. Now, before we wrap this up, I want to mention the huge silver lining that comes from having those QTIP assets included in the surviving spouse's estate. Because of that Section 2044 inclusion, the assets get a brand new income tax basis under Section 1014. We call it a step up to fair market value. And what that does is it can completely wipe out decades of built-in capital gains, which is just a massive, massive win for the heirs. This quote really says it all. The QTIP isn't something to be afraid of, but it absolutely demands precision. It's one of the most powerful and flexible tools we have for hitting both tax and family planning goals, but only if you fully understand and respect all of its complex moving parts. So the takeaway here is not that QTIPs are a trap. It's that the fear of double taxation is a myth, but the real traps are hidden in the technical details: an accidental waiver of recovery, a deemed gift under Section 2519, a state tax decoupling issue. Those are the real dangers. So the question you should be asking yourself is this: is the language in your plan specific enough to navigate this incredibly complex world?